That mortgage rejection you just got? It wasn't about your income. You made $180,000 last year, and the bank still said yes to someone making $65,000 on a W-2. Here's the truth they won't tell you. Banks don't see you as self-employed, they see you as unemployed with a side hustle, and it's costing you everything. Look, if you're self-employed and you've ever applied for a mortgage, a car loan, or even a decent credit card, you've felt this. You know you make good money. Your business is solid. You've got cash flow. But the moment you check that self-employed box, everything changes. The bank that was practically begging to give you money suddenly wants 2 years of tax returns, 3 months of bank statements, a letter from your CPA, proof of future contracts, and probably a blood sample. Meanwhile, your cousin who makes half what you make walks in with a pay stub and walks out with a loan. It's frustrating. It feels personal. But here's what they don't tell you. It's not actually about whether you can pay them back. It's about how they've mathematically categorized you as risk. And once you understand the system they're using to evaluate you, you can game it legally. I learned this the hard way. 7 years ago, I was a freelance consultant pulling in about $220,000 a year. Good money, consistent clients, growing business. I applied for a mortgage on a house that was well within my budget. I was putting 20% down, my debt-to-income ratio was solid, and I had a 780 credit score. Rejected. Not even a counteroffer, just no. I called the loan officer, and she said something that made my blood boil. She said, "Your income is too unstable. We can't verify consistent employment." I had been running my business for 4 years, same clients, growing revenue every single year. But because I didn't have an employer, I was unstable. That's when I discovered something that changed everything. Banks don't evaluate self-employed people the way they evaluate W-2 employees. They use a completely different underwriting formula. And if you don't know what that formula is, you're going to keep getting rejected, or worse, you'll get approved but with terrible terms that cost you tens of thousands of dollars over the life of the loan. Now, this matters most if you're self-employed, making at least $75,000 a year, and you're planning to apply for any kind of credit in the next 12 months mortgage, car loan, business line of credit, whatever. If that's you, keep watching. Because what I'm about to show you is how to position your income, your business structure, and your documentation so that banks stop seeing you as high risk and start seeing you as their ideal customer. And yeah, this works in the US, Canada, the UK, and Australia. The specifics vary slightly, but the core principles are universal. But before I show you how to fix this, you need to understand exactly why banks do this. Because once you know the why, the how makes perfect sense. And it all comes down to 3 words that banks are obsessed with. Let me show you what those 3 words are. Predictable, verifiable, recurring. Those are the 3 words that banks use to evaluate your income. And here's the thing, W-2 employees automatically check all 3 boxes. Their income is predictable because they get paid the same amount every 2 weeks. It's verifiable because there's a paper trail from an employer. And it's recurring because they have an employment contract. You, as a self-employed person, you check exactly 0 of those boxes in the bank's eyes. Your income fluctuates month to month. Maybe you had a $30,000 month in March and an $8,000 month in April. The bank sees that as instability. Even if your annual income is great, your income is harder to verify. You don't have an HR department sending a verification letter. You have tax returns, which, let's be honest, most self-employed people try to minimize because of taxes. So the bank sees a lower number than what you actually made. And recurring? Forget it. The bank assumes that your biggest client could disappear tomorrow, and suddenly you're making nothing. Now, is this fair? Absolutely not. Is it reality? Yes. But here's where it gets interesting. Banks aren't actually afraid that you can't pay them back. They're afraid that you don't fit their automated underwriting algorithms. See, when a W-2 employee applies for a loan, the bank plugs their info into a computer system and it spits out an approval in about 90 seconds. Easy, efficient, cheap. When you apply, you become what they call a manual underwrite. That means a human has to look at your file, assess the risk, and make a decision. That costs the bank time and money, and banks hate that. So they've built the system to discourage self-employed applicants not because you're actually risky, but because you're expensive to evaluate. Quick question, pause for a second and answer this honestly. Have you ever been rejected for a loan or credit card even though you knew you could afford it? If yes, comment rejected below, because what I'm about to show you next is specifically how to fix that. And if you've been approved but felt like the interest rate was way higher than it should have been, comment high rate, because that's the same problem, different version. Okay, so now you know why this happens. Banks see you as expensive to evaluate, so they either reject you or charge you more to offset their perceived risk. But here's the part most people don't know. There's a way to restructure how you present your income so that you do fit into their automated system. You stop being a manual underwrite and start being a auto approval. And it starts with understanding the two types of self-employed income that banks actually recognize. When you apply for a loan, the bank categorizes your self-employment income into one of two buckets: Schedule C income or business entity income. If you're a sole proprietor or a single-member LLC filing as a disregarded entity, you're reporting Schedule C income. This is the worst possible position to be in when applying for a loan. Why? Because Schedule C income is heavily deducted. You've written off your home office, your mileage, your equipment, your meals, all the stuff your CPA told you to deduct to lower your taxes. Great for taxes, terrible for loans. The bank looks at your Schedule C, sees that you made $150,000 in revenue, but only reported $62,000 in net income after deductions, and they underwrite you as a $62,000 a year earner. Not $150,000, $62,000. Now, business entity income, that's different. If you're an S-Corp, a partnership, or a multi-member LLC, the bank evaluates you differently. They look at your K-1 form, which shows your share of business income, and they often allow you to add back certain deductions like depreciation and home office expenses. This is huge, because now, instead of showing $62,000 in income, you might show $95,000 or $110,000. Same business, same revenue. Different presentation. But here's the catch. Most self-employed people don't know this, so they stay as sole proprietors, maximize their deductions, and then wonder why they can't get approved for anything. Let me give you a real example. I had a client, freelance graphic designer, making about $140,000 a year in revenue. She was a sole proprietor, and after deductions, her Schedule C showed $48,000 in net income. She applied for a mortgage and got rejected. We restructured her as an S-Corp, adjusted how she paid herself, and reduced some of her aggressive deductions. Her tax bill went up by about $3,200 for the year, but her bankable income went from $48,000 to $89,000. She reapplied 6 months later and got approved. Same person, same business, different structure. Here's a test. Do you know if you're filing as a sole proprietor, an LLC, or an S-Corp? If you're not 100% sure, comment "not sure" below, because that answer determines everything about how banks see you. And if you're a sole proprietor wondering if you should switch to an S-Corp, drop S-Corp info in the comments and I'll make a full breakdown video on exactly when it makes sense to switch. All right, so now you know the income piece. But income is only part of the equation. The second thing banks look at is stability. And this is where most self-employed people shoot themselves in the foot without even realizing it. Because there's a specific documentation strategy that makes you look stable, even if your income fluctuates month to month. Let me show you what that looks like. Banks want to see 2 years of consistent self-employment income, not 2 years of the same business name necessarily, but 2 years of self-employment in the same industry. If you've been freelancing for 4 years, you're golden. If you left your W-2 job 6 months ago to go full-time self-employed, you're going to struggle. Most banks won't even look at you until you've got 24 months of tax returns showing self-employment income. But here's the workaround. If you were doing freelance work on the side while you were still W-2, and you can show 2 years of Schedule C or $1,099 income, even if it was just $10,000 or $20,000 a year, you can qualify. Because now you've been self-employed for 2 years, you just went full-time recently. Most people don't know this. They think the clock starts when they quit their job. It doesn't. It starts the first year you report self-employment income. Now, the second part of stability is showing consistent or growing income. If your tax returns show $80,000, then $120,000, then $150,000, that's a beautiful upward trajectory. Banks love that. But if your tax returns show $150,000, then $95,000, then $130,000, that's volatility. Even though your average is still over $120,000, the bank sees risk. So here's the strategy. If you know you're going to apply for a loan in the next 12 to 24 months, you need to start planning your tax returns with that in mind. Yes, you want to minimize taxes, but you also want to show a stable or increasing income trend. This might mean being slightly less aggressive with deductions in year 1 and year 2 if you're planning to apply for a mortgage in year 3. I know that sounds counterintuitive. You're paying more in taxes now to qualify for a loan later. But here's the math. Paying an extra $5,000 in taxes over 2 years, so you can qualify for a $400,000 mortgage that saves you $150,000 over 30 years compared to renting. That's a good trade. The third piece of documentation is bank statements. Banks want to see reserves. For self-employed applicants, they typically want to see 6 to 12 months of mortgage payments sitting in your bank account as reserves. For a W-2 employee, they might only ask for 2 to 3 months. Why? Because again, they see your income as unstable. They want proof that if your business has a bad month, you can still pay your mortgage. This is where a lot of self-employed people mess up. They run everything through their business account, pay themselves inconsistently, and their personal bank account balance is always low because the money's in the business. The bank doesn't care. They want to see reserves in your personal account. So if you're planning to apply for a loan, start building up your personal savings at least 6 months in advance. Pay yourself a consistent salary from your business and let that cash accumulate in your personal account. Don't touch it. That's your reserve fund for underwriting purposes. Be honest. Do you pay yourself a consistent amount every month from your business, or do you just transfer money over whenever you need it? If you're in the second camp, comment inconsistent below. No judgment, most self-employed people do this, but it's killing your loan applications, and I'm about to show you how to fix it. All right, so we've covered the income piece and the documentation piece. But there's a third factor that almost no one talks about, and it's the one that can actually get you better rates than W-2 employees. It's called debt-to-income ratio optimization, and it's how you turn your self-employed status from a liability into an advantage. Let me break this down. Your debt-to-income ratio, or DTI, is the percentage of your monthly income that goes toward debt payments. Banks want this below 43% for most loans, ideally below 36%. Here's where self-employed people have a massive advantage. You control your income presentation. A W-2 employee making $100,000 a year. Their gross monthly income is $8,333. The bank uses that number. They can't change it. You, as an S-Corp owner making $100,000 a year, you might show $60,000 as W-2 wages and $40,000 as distributions. But if you're applying for a loan, you can adjust your pay structure 6 months before you apply to show higher W-2 wages, which some banks weigh more favorably. Or, if you're an LLC partnership, you can add back certain deductions to inflate your qualifying income without actually changing your tax liability. This is advanced stuff, and it requires working with a CPA who understands mortgage underwriting, not just taxes. But the point is, you have flexibility that W-2 employees don't have. The key is planning. If you know you're applying for a mortgage in 12 months, you sit down with your CPA and your mortgage broker today, and you reverse engineer your income presentation for the next 2 tax years to optimize for underwriting. Most people do it backwards. They file their taxes to minimize liability, then apply for a loan and wonder why they can't qualify. You have to plan ahead. So here's what we've covered. Banks see self-employed income as unpredictable, unverifiable, and non-recurring. They categorize you as high risk, not because you actually are, but because you don't fit their automated systems. But now you know the 3 strategies to fix this. Restructure your business entity to show higher bankable income, document your stability with consistent tax returns and reserve funds, and optimize your debt-to-income ratio by planning your income presentation in advance. These 3 moves, they're the difference between getting rejected and getting approved, between paying 7% interest and paying 5.5%, between being seen as risky and being seen as their ideal borrower. But here's what I didn't tell you. Even if you do all of this perfectly, there's one mistake that self-employed people make during the application process that gets them denied at the last minute, and it happens after they've already been pre-approved. It's called a credit event trigger, and it's brutal. I'm breaking down exactly what that is, how to avoid it, and the 30-day window before closing where you have to be absolutely perfect in the next video. If you're planning to apply for any kind of loan in the next year, do not skip that video. It could save you from losing your dream house or tanking a deal at the finish line. If you're self-employed and you're serious about being treated like the financially stable, high-earning professional you actually are, hit that subscribe button. I drop one of these every single week, and each one is a strategy that makes banks work for you instead of against you. See you in the next one.